Good morning. I'll start by talking about the economics of the budget. And doing that, I'll go through a couple of paragraphs that I wrote last night and then flick to the charts. I'd say that if Jim Chalmers was an economist, he might have said that inflation was the biggest problem facing the Australian economy. And if he was an economist, he might have talked about the importance of increasing investment. And he might have said that by increasing investment, we increase the level of capital stock. As capital stock rises, then productivity goes up. And the higher productivity allows the workforce to increase the supply of goods and services and pushes costs down. And then he might have talked about various ways in which he was increasing investment. But he didn't do that, and he didn't talk at all really about inflation because he's not an economist, he's a political scientist. And what he did was he talked about the delivery of government-funded services. Nothing wrong with that, except it just had nothing to do with productivity and nothing to do with inflation. His signal achievement was that he produced a positive balance of $4.2 billion in the 2022-23 budget in a circumstance where the economy last year was $2,449 billion. That meant that he was producing a budget balance of 0.17% of GDP. And that, to me, is not a surplus. That's just achieving a budget balance. But it's good if you can get whatever balance you can get is a great balance to achieve. In terms of the outlooks in the charts, what we see is really from now on, the very tight labour market generates wages which rise faster than inflation. And that's achievable if you have productivity. But if you don't have productivity, you can't keep doing that. One of the interesting things is we do have a fall in the terms of trade. That's definitely going to happen, I've got to tell you, because we've had the highest terms of trade in our economic history. But really interesting, it interests me that in the charts, this is in chart 2.8, my figure number 2, it doesn't really fall all that far in comparison to previous cycles. And we wind up with the terms of trade still higher than it was in 16-17. Unemployment in figure 3 rises. But to me, the other thing is, and I didn't comment it at all in the text, is in figure 4, which is table 1.2 of the budget aggregates, is what happens to debt. So what Chalmers believes he's done is just provided just enough balance of the budget to stabilise the debt to GDP ratio. And the debt to GDP ratio stabilises at around about 36% of GDP by 25-26, or 24% of net GDP. Well, that's really important, is he has to stabilise that net debt to GDP to make sure we keep our AAA debt rating. That's crucial. So he's done just enough of a budget balancing act to keep us keep being a AAA rating, but not enough to have to do anything with inflation. He's relying on the RBA to do all of the work as far as inflation is concerned. Underlying cash balance improves. That's because of the terms of trade. Spending, social security and welfare. He's talking about in the budget, he's really talking about delivering welfare services. And that's overwhelmingly the biggest section of the budget spending, 35%. Defence is only 6%, in spite of all of the expenditure on AUKUS, still overwhelmingly social security spending and health spending are the big ticket items. As I say, he's generated a circumstance where he's leaving the job of reducing inflation entirely to the RBA and not tightening the deficit enough to reducing the deficit enough to have any real effect on inflation, and hence that's one of the reasons I think it's inevitable that the Australian cash rate needs to go 100 basis points higher than it currently is to keep inflation down to the kind of targets that both Treasury and the RBA is anticipating.
Just following up from Michael, look, like you said, economy remains in a very strong position, and I guess from a market perspective, not a whole lot of surprises given a lot was pre-released. It was pretty light on any significant market-sensitive spending programs, so a very tame budget compared to what we've seen probably over the last few years. We saw, as Michael alluded to, strong employment growth, strong commodity prices, which has done really a lot of that heavy lifting. So the government doesn't really need to make those real difficult decisions this time around. So positive for the market was the fact that there wasn't any major, like Michael said, inflation-inducing policies that have probably been a feature of the Labor governments over years gone by. So it's unlikely, I think, to scare investors in thinking there'll be further, significant rate rises on the back of this. I note that S&P has reaffirmed the country's AAA credit rating, which will keep borrowing costs low and obviously important factor for the major banks. Though one thing to watch for is obviously that debt position. As Michael talked about, debt to GDP remaining consistent over the forecast years, but I note that NDIS spend, aged care as well as Medicare continues to outpace inflation. So it's important at some stage to take a look at those categories which continue to grow. So the big decisions still lie ahead. So on the whole, we don't think there's enough in the budget to massively change investor sentiment probably either way here. Spending to support the economy, particularly the vulnerable, will perhaps helps offset some of those downside risks to the economy if the economy does start to slow down. So spending, I guess, in the right places there to those parts of the economy that are most hard hit by the cost of living. So all in all, look, that $14.6 billion that have been committed to that cost of living relief, we think that will help potentially in offsetting some of the weakness there. So AGL and Origin with that energy bill relief, so at the margin there, potentially some benefit to those, as well as some of the staples, obviously, by helping that cost of living relief, helping some of those staples out. Bringing forward that PRRT and some of the changes to the petroleum resources rent tax, that's been well flagged. So bring that forward. Adrian thinks that's only going to really hit Santos and Woodside at the margin as well. There was also an announcement around a $2 billion commitment towards commercialising hydrogen. I guess the devil will be in the detail there, but at the moment, a bit light on detail, so hard to say where that's going to end up and who that's going to really benefit, but that's something to watch for. But otherwise, look, a pretty safe budget from our end, from an equity market perspective, really helped by favourable economic conditions and not to mention also a favourable political climate for the government. So all in all, one that, is generally on the whole can't move the dial either way for the equity market. So I might hand over to Terri just to talk about the wealth management side.
Thanks, Tang, and good morning, everyone. I think I was certainly in bed well before Tang and Michael. It was a very low-key budget for wealth management, and I'll let you read the papers. You can see the changes there with the employer super guarantee obligations being paid in time, in real time, as pays are paid rather than quarterly. That will take effect from 1 July 2026, and that's just giving employers the time to get their systems in place. But what I wanted to talk about this morning, really what wasn't included in the budget, what was omitted. And unfortunately, we saw no further detail on the 3 million cap and the tax on earnings above that threshold. So we can only assume the government will push forward with that 3 million cap not being indexed, nor any comments on the unrealised capital gains, etc. So we'll wait and see how the draft legislation comes out on that. Also, no mention of whether the 50% minimum pension reduction will continue beyond this year. We did think it was highly unlikely that it would continue. So perhaps, speak to your clients about their cash flow plans now start looking at your liquidity within your super funds in anticipation of those minimum pensions going back to normal from 1 July 23. The transfer balance cap, total super balance cap thresholds to 1.9 million, highly certain to index. In fact, they will index to 1.9 million this from next financial year, 1 July 2023. Also, you may remember last March, the budget last March from the Coalition included two pretty good superannuation changes that were common sense, and that was being able to allow legacy pensions, the old defined benefit pensions and non-commutable pensions, to be withdrawn or redeemed in over a transitional 2-year period. Unfortunately, there was no mention of this in the budget. The Treasurer had intimated previously that they will look at that, and I think they will still look at that, but nothing in this budget. So we don't really know what their plans are on how soon they might introduce some kind of transition period to unwind those legacy pensions. And also the changing the residency rules, particularly for small business, self-managed super funds, in relation to the extending the time frame for active assets and being overseas for a greater period of time. So again, what wasn't in the budget more telling than what was actually included, which wasn't much, and I'm not complaining. We don't like changes to superannuation. We've already had enough. So that's probably it from me. Thank you.